Good evening, everybody. It's Blair Nightingale here on Market Monday. We're getting fired up. September 18th, getting into the end of the year. Close. It's amazing, amazing, amazing. September, historically, one of, if not the weakest month for the stock market of the year. Is that what's happening this time around? We're going to take a look at that. We've been going week to week here with so much news driving the market. I got a couple things I want to say specifically about that tonight, because as traders, not investors, you say, well, isn't trading a kind of investing? Yeah, you could say that generally speaking, but more specifically, there are two different skill sets: traders, investors. The investor is long-term, okay? How long is long-term? Well, for the trader, it depends on what kind of trader you are. But for the swing trader, anywhere from 2 days to about 3 to 4 weeks, you are looking at anything longer than that is considered more long-term. But true investing long-term, you could look at the tax code, right? And anything held for longer than 12 months would have long-term capital gains tax, for example. It's a different rule when it's shorter than 12 months. So you'd be looking at long-term out of that perspective beyond 12 months. So the point being, anything short-term becomes less fundamentally based and more technically based. In other words, the stock, the way we are going to choose whether or not we want to do business in or with a specific stock as an investor is going to be much more the long-term horizon, much more the fundamentals of that company, of the overall economy, things like that. Here on Market Monday, we try to give value to people all the time who are looking at the markets from more of a macro perspective, longer term investing perspective. And we cover that extensively here. But really, for traders, that kind of stuff is less important in most, not all, but in most cases. So I want to talk a little bit tonight about how sometimes traders get tripped up a little bit when they spend too much attention, time, energy looking at the longer term fundamental picture and not really understanding how we use trading as a skill set when it comes to price itself. Because price, or technicals, is king for a trader. But there's a lot different emphasis when we move into the investing side of things. Short-term price swings, that's not really a big deal for a long-term investor. If it was, the long-term investor wouldn't be very long-term, right? They'd be getting in and out of positions constantly, and that's not what they do. That's not the name of the game, right? A swing trader is looking for swings in the price. We'll look at a couple of stocks from earlier this year that were making very consistent swings in the price so that we as traders could look to take advantage of those swings. Now, their traders have skill sets as well, specifically with options, that can open up that time horizon and approach the markets a little bit differently. But I'm going to show you some swing trading charts tonight so that we get an idea of what that looks like. So I say all that because we usually start Market Monday, especially in this series we've been doing now for some time, just market updates, where we talk a lot about the news. I've got some news I want you to be aware of. It's important every week. Traders, despite what I just said, there are some. Remember, I said it's not that all news is less important to the trader, but most of the longer term horizon is less important. Some of it, however, is very important. I bet some of you guys could guess what some of those news items might be that we want to pay attention to. That said, if you do have a guess, if you want to say hello, if it's your first time, if it's your 50th time with us here on Market Monday, go ahead, drop a comment into that comment box. I invite you guys every single week to do that. Would love to hear from you, know where you're from, where you're coming to us from tonight, because we love to hear from everybody who's on here. I know many people, you'll be watching this by recording, so good evening to you as well. But for our friends who are with us live, please go ahead and drop a comment in there. Love to hear from you guys. And as I said, maybe you have a guess on What's a big news item this week? Now, some of you guys who were with us last week, I gave you a resource of something, a website that you can go to and you can see every week what's the primary. Now, it's going to show us a lot more than the primary, but what is the primary economic news that we need to know for this week, right? It's a good check-in for traders to have. And of course, this week, it's obvious what's on there. I'm not going to pull up that specific resource tonight. However, it is the Federal Reserve, of course. Tomorrow they're meeting. Wednesday they're meeting. And then Wednesday also they will have really the biggest thing that's going to happen this week is the statement from the Fed Chair Jerome Powell. He'll be coming out and making a statement. 99%, right? There is a consensus 99% probability that the Fed does not raise interest rates this week. So this week for traders, we're not really concerned so much about whether or not they raise interest rates. Now, at a 99%, if for some reason the Fed did go and raise interest rates, would that be a pretty big upset? Would that be a pretty big surprise? It would. It absolutely would. And so that would cause some pretty significant volatility. However, the probability of that happening very low. So that's not really what we're watching this week. What we're watching this week is to see where are they going from here, right? What is the next steps when you get one meeting where the rates are frozen, they're held? Does that mean we're done? Is the cycle over? Are they done? Are they going to hold it, right? What's interesting, if we go into the chart, and I showed you this last week, one of the things that is more fundamental, if you will, longer term is right here on the energy sector. Okay. I'm going to get us a bigger view here, right? It's been going sideways for some time. Now, this is the S&P energy sector ETF. So it has come up into these highs that we had. If you remember when gas was way up, we had some pretty significant highs that came in. Well, it's pushed into that high, right? Oil and gas went to the same price, the highest, I should say, highest price it's been at since November of last year. Not as high as it was when gas prices were, double digits in California, but it has been in a very steep incline. So I'll be very interested to know what the Fed has to say this week in particular, because I'm wondering if they're actually looking ahead, something that they did not seem to really do for a while, looking ahead and going, all right, well, if oil and gas prices are climbing significantly, remember last week we talked about how the CPI, consumer index, and the PPI, the producer index, both inflation gauges. How much are the prices of things inflating? That's all we need to know. When those things are higher, obviously, that's something the Fed's going to take note of, okay? So what's happening is if oil and gas is going up, right, then we may see those prices inflate significantly more in next month's reading. Next month, October, will give us the results for this month, September. If that happens, we could see that significantly rise again. Why do I say all that? Well, because it's something I want you to understand. Why is it on the radar? Well, yeah, but is that the most important thing that I need to know when I go out and trade a specific stock? In most cases, no. Okay, you don't necessarily need to understand all the ins and outs of that, but at the same time, you don't want to get caught off guard not knowing what's going on, especially if you are trading on a Wednesday and you had no idea that the Fed was coming out, and you may get an upset, a surprise from something like that. Also, again, we want to inform you of the longer term picture and what's really happening here. So that's what I'm starting to see. If that really inflates the reading next month, I could see them saying this month, you know what, we're going to be data reliant. We're going to keep our options open, and we may need to do it again. All right. That's probably what they're going to say. I think it's very interesting to consider that even though they look at a gauge, what they call core inflation, it removes food, it removes energy. What that does is it just takes some of the volatility out of the reading to get what they might say is a little bit more accurate of a long-term reading. But even that went up last week. Okay. The president came out and said that things are trending down. Inflation is trending down, when in fact, the reading that last week did not go down. It went up. So that was not a true statement from the president. So Ivan says, hello, Blair from Hyattsville, Maryland. Hope all is well back after a long hiatus. Hey, we're still here. So good to have you, Ivan. Appreciate you being on here. So that's what we're looking at this week. So we need to watch out for where that may land on Wednesday, as always. So the question that always comes through then is, well, should I trade anything between now and Wednesday then? Okay, here's something I want to say. Here at Tradeway, we talk about building trades, right? Finding opportunities in this way, okay? As a trader, we need to separate price action from price edge. The trader, this is the very foundation, basics. Trading is separating price action from price edge. What is price action? It's simply the movement of prices. Prices are moving. When the market is open, prices are moving. When prices move, there is a sense that one could potentially make money off the price movement. That's true, but what's the problem? If we don't have a consistent edge, then we can't consistently look to define that's high probability and that's not. That's high probability and that's not. I want high probability. There's no guarantee, right? But there is higher probabilities. So how do I differentiate from action, price action, to price edge? Well, there's many ways to do that, but the number one way we begin to do that is say, all right, I need 3 legs on this trading table, we like to call it. On any table, if you chop one of the legs off on a 3-legged table, what's going to happen to the table? Of course, it's going to fall over. It's going to fall over. So we need to have those 3 legs, okay? Now in trading, I mentioned technicals are king, but it's not the only thing. We still have some fundamental understanding, okay? Number 1. Number 2 is price, and we really do this in price primarily with patterns, price patterns. What happens in a pattern? If I said to everybody out there, some of you heard me say this, square, square, circle, square, square, circle, square, square. What would you say is likely to be the next one? Circle. Guaranteed? No, but it's a pattern. Patterns, okay? When you recognize patterns, what has happened in the past, driven by human nature, has a tendency to repeat again. That's what a pattern is. Well, did you know that the stock market makes patterns as well? The stock market makes patterns. So if the stock market makes patterns, we can recognize those patterns and look to exploit them. That is the difference primarily between price action and price edge. Okay. I want edge. I don't want action. Chasing action is useless over time. Maybe in one trade, maybe in 2, we're profitable, but it's more guessing, gambling, or going for it than it is actual trading. Over time, that's not what works. So we want price edge, okay? Joseph says inflation is going back up. Seems like the government is hiring, I believe, higher rate hikes again, Joseph says. And maybe not at this particular meeting, right? But again, in the future, if inflation isn't trending down, they've already made it clear that they may need to do that again. And that's going to put more pressure on the economy. Over the course of this year, we have covered extensively how rate hikes could affect the economy, how that's affected banks, how that's affected the bond market, how that's affected the job market. And certainly job market, I think, still is the thing to really be watching as that begins to constrict. That could be a significant catalyst. And consumer spending has been really strong. So if consumer spending starts to really constrict, it's amazing how resilient the economy has been, given the fact that inflation has gone up and many people across this country are living paycheck to paycheck. Remember, the stock market It is companies. If companies are making money, then they're growing. Okay. If companies are making money, they're growing. If they're growing, then the stock market tends to advance. But where's the money coming from if everyday folks can't really afford as much as they used to? Well, a lot of it is debt. Auto loan defaults getting up to record highs, if not record highs already. Credit card debt in this country, record highs. Okay. I read an article the other day that said even just a little bit of a pullback in the Canadian housing market has actually meant that a lot of people are negative on their payments, meaning they're making their mortgage payments, but it's actually not even covering the interest from month to month. They're not even getting into principal payment. It's just interest. Now, we haven't seen that here yet, but there are signs all over the place that things are getting very tight for people. So, how are they keeping up? How are they continuing to spend so much money? Joseph said savings and credit card. And that's exactly it. We're seeing credit card debt go up, 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 up. You know, I wouldn't be surprised if before too long we start hearing cries for the government to forgive credit card debt. I don't know if that'll ever happen, but in this day and age, in this culture, it seems like the government is meant to be the fix for just about anything. Well, if credit card debt is going up and somebody makes the argument to say, well, we're just using that just to get by, obviously that's one scenario. But again, consumer spending across the board hasn't really taken the kind of hit that people would have thought. Okay. So that leads me to believe that, yes, savings and credit card debt are highly responsible for that. Now, I did see something that said the Christmas season is expected to see a pullback in consumer spending. So that'll be interesting to see. That's more the long-term picture. Okay. Yeah. So if you look at the actual markets right now, okay, we had a wedge going here, right? This is what we call a pennant wedge. It's pattern, right? It's going, tops are getting lower, bottoms are getting higher. It broke out of that on Friday. So if I actually go in here and oops, that was the wrong one, but that's okay. I'll clean this chart up. And I get that out of here. And I'm going to put a line in right here. Okay. And put another one up just to mark these highs right here. What happens here is this comes up into this level, comes down, goes up, but what does it do? It makes a lower high, right? We're just using the price to read. This isn't fortune telling. This isn't guessing. We're just letting the price tell us what it's doing. That's all we're doing here. It's a way to recognize what the price is doing. Okay. If we break below this 50-day moving average, this blue line here, okay, then I would look for a move back down into 44.15. Okay. And of course, beyond that, down into this level here. I would really go down into these lows here around 43.60. Okay. You've got that dotted red line, that 100-day moving average still down there. It's not going to move very quickly, but remember, as the market descends, if it drops, it's going to pull that average down a little bit because it is an average. So we'll probably get close to that 44.60 price in that area to watch being level with that 100-day moving average. Now, that's if it moves below the 50-day. That's what we're really looking at today. So I don't expect much to happen tomorrow. Little bit of up and down today, but not much. A lot of caution. You can see they pushed it up into the 10 and 20-day moving average, sold it off right away. Why? Because they don't want to leave that risk on the table, because they're going into Wednesday. They'd rather wait, take profits at the first place they can take profits, 10 and 20, take profits, get out, and then see what happens tomorrow, playing it cautious going into a news item like that. The Fed comes up all the time, right? We've talked about the Fed constantly. One of the things is this really the end of that rate cycle. I think overall, guys, it's still warranted that you and I be of the mind that the system, and while this is true in any season, right? Because we're not sovereign over the system, okay? There's only one that is. But the system has a lot of cracks. Okay. I'm not being the doomsday preacher here on Market Monday tonight, but I'm telling you, there are a lot of cracks in the economy, and it only takes a few things converging to push it over the edge. Okay. I'm not saying that's going to happen tomorrow. I don't know that. But I am saying that you and yours should be aware that we could have a recession, a real recession, and a significant slide drop in the S&P really at any given point. And what I need to say is, do you understand how to A, make money when the market moves down? B, protect what you already have when the market moves down. I've told people for years, the most significant conversation you can have with any financial advisor that you currently have, assuming you have one, because many of you don't have a conversation with them because you don't have one, or you already fired them. You're self-managing. You're doing this yourself, okay? You know, a vast majority of money managers on Wall Street don't beat the S&P index, and they sell you financial products that charge you fees that don't seem like a lot of money, but over a 10, 20, 30, 50-year time horizon, those 2 to 3% fees create a significant difference in your returns. You put up the capital, you take all the risk, they get the majority of the returns over those longer time horizons. It's just a thought. Back to my point, we have to understand that good questions bring good answers. And a good question to ask anybody who's managing your money is, what is your plan for volatility? What is your plan for a bear market? And my suggestion, this is Tradeway's philosophy, if set it and forget it is the only thing they tell you, you may want to look for a new manager, because holding it all the way to the bottom, and I'll just say this quickly, is not what Wall Street does. Blair, can you prove that? Yes, I can. How? The market goes down. When the S&P 500 goes down, over 80% of stocks owned on Wall Street are owned by institutions. When the market crashes, or when it goes on a massive bull run, it's not retail investors like you and me that are making that happen. It's institutional money. When the market is going down, they are selling. So if they sell when things get bad, but tell you to hold on for the ride, do you think there's anything wrong with that scenario? I just posed that as a question, folks, right? There's a system out there, may not always be in your best interest. That's the question we pose here at Tradeway. Joseph says, when is the government shutdown? It's coming closer. I don't know exactly when that is. We talked about that a little bit last week. If, of course, they don't reach a deal, and these things just tend to run right down to the wire nearly every single time. Would that be a short bear excuse? You know, whether or not that really creates negativity, we'll have to see. We'll have to see. You know, there are many disappointed bears this year. Okay. The yield curve, okay, short-term and long-term interest rates. When I take out a bond that's a month long and I get paid more to park my money for a month than I get paid to park my money for a year or 5. Okay, that's weird. Taking risk for a month and getting paid more than I would if I took it for longer. Now, these are fairly low risk instruments in the case of a T-bill or something like that. But the point is that that is what we call an inverted yield curve. When the short-term instruments are paying better than the long-term, that yield curve has been used as a signal for recession for a long time. And since the 70s, every single time that yield curve has inverted, it has signaled a recession in the United States. Okay. It is deeply inverted and has been for some time. Now, that said, I mentioned a lot of bears have been disappointed this year. Why? Because the market didn't really crash. It didn't really crash like they thought it would. It didn't really crash like it has. And I've said this many times. I won't go into this extensively here, but it's really, in my opinion, this is Blair's opinion, is because of where we've come out of post-COVID. Okay. The free money party, okay, that Wall Street enjoyed over years of near zero interest rates, and then over COVID, I think the market is just drunk on that kind of optimism. I also think fundamentally the economy really has held up better than people thought it would. Okay. There's confidence that the government will run in and fix anything with cash as soon as it happens. The consumer has been spending at a healthy level and the jobs market looks pretty good. So, for those reasons, it has held up. But I'm telling you again, and I'll wrap this section with this thought, this economy is it is fractured. It is cracking. There is an election cycle coming. Okay. Now, historically, an election cycle in and of itself has not tanked the market. The market may be particularly pleased with a candidate winning or losing, okay, based on the economic expectations. So there are those factors, but that tends to come more around the actual election. So that said, there's a lot of potential volatility coming, a lot of uncertainty. It's going to be a wild year for our country. I think we absolutely need, you know what? I'm going to say this about myself, and y'all can take it or leave it. I need to spend less time. I was reading First Timothy with my wife yesterday. I need to spend less time looking at the media and more time, and I should say it this way, less time looking at politics and more time looking to the Lord, because we need prayer. Our nation needs prayer. Our nation needs prayer. Our nation needs the Lord to do a lot of we need a revival. We need a lot. We need a lot. So that said, I think there's a lot of potential bumpy roads ahead, and that is not an exception for the economy, despite how people, I think Janet Yellen, the former Fed chair, came out and said that she feels like the economy is in great shape. Well, keep in mind she's Democrat. She's appointed by the president. She's not going to come out and say, it doesn't look so good, And, it's kind of her job to make sure the economy looks good. So I don't think she's going to come out and throw herself under the bus. Okay. There are plenty of reasons to know that I should be getting ready to protect myself. Maybe not tomorrow, maybe not next month, maybe not before the end of the year. I don't know. If we'd known the hour, right? I've been quoting this a lot this last year. Hey, if we'd known the hour, right? Then we would have, if we'd known the hour the thief was going to break in, we never would have let it happen, right? Jesus says, you know how to read the signs, the weather rather, okay? But you don't know how to read the signs of the times. Now, of course, he's speaking spiritually and theologically, but it's a principle where we go, well, you know how to recognize a change of season, even though you maybe don't know the exact date and time. We need to look at the season. There's no question that things look negative in a lot of ways, and they could break. The chart for our traders out there, though, will be king, okay? No matter how negative it seems, if this chart, okay, right here, the S&P 500, starts recovering more and more and more and is blasting into new highs, you and I can say all we want. Hey, it should be going down. It should be going down. It should be going down. But the market's going to do what it wants to do. It's a very important lesson because you can't make the market do what you want it to do. I can't make the market do what I want it to do. I was going to show you quickly, understanding how to identify price action, price edge. I was just working with a student on this particular pattern right here. It moves up, down, up, down, up, down, up, down, up, down, up, down, up, down. Okay. That's very consistent. Apple did it all year long. Okay. Here's another one. I won't annoy you by saying up, down, up, down, up, down, but it's moving up, down, up, down, up, down, up, down, and so on. Okay. This is the difference: price action, price edge. So we spend time getting really good at finding out how those patterns work. If you guys have not, you can always go back. You can see a lot of Market Monday. From the last 3 years, we've got episodes right here, and we're covering all kinds of topics. Tonight, difference between investing and trading and really understanding price action, price edge, and then knowing, do I really know how to benefit if the market crashes? And do I know how to protect if the market crashes? Plenty of people I meet traveling all around the country who took a significant hit in 2022. Okay. It doesn't have to be that way if we understand how to use some basic instruments to protect our assets. People say, Blair, I'm told by my financial guy, you can't time the market. What I'm stating right now actually has nothing to do with timing the market anyway, in terms of moving my assets out of stocks into cash or something of that nature. I think there's a conversation to be had around that. I think there's some straw man arguments that get said so as to disqualify being able to move assets. Remember, though, you're also talking to some people sometimes who, if you move your money to cash, that's not what they want you to do. Okay. So that said, I'll leave that to you. It's something to keep in mind as we move forward this year if situation, deteriorates as we go on. Okay, guys. Well, that's Market Monday this week. Watch for the Fed announcement on Wednesday. That's a big deal. We're looking for patterns. Learn how to use that. If you haven't, we got a step one, start your journey, coming up next month. Okay, we're almost at the end of September. So it's coming up in October, and you can come in and join us for that and learn our foundational stock trading system. If you've never done it before, it's perfect for newbies. If you have done it before, you're going to put yourself in a community of people who've been doing this for a long time. And that is a great thing for people who know that it takes practice, it takes community, because trading can be a lonely profession if you're just staring at your computer and trading. And we want to get you off the computer more too. So there's plenty of things to learn in that course to fit it into your life and understand the potential of what it is and use it for yourself. You can head on over to tradeway.com and find us right there on our events page. Step one, start your journey. Ivan says, thanks, Blair. Have a great week. Appreciate you guys. Have yourself a great week, and we'll see you next time. Good night.